Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. I am Prashant. Well, I'm not in the studios, as you can see. I'm coming to you from the sidelines of the Morgan Stanley Annual India Investment Forum. It's a marquee event as far as investments go here in India. And I'm coming to you from the sidelines of it. We're sitting down with a very special guest who I'll introduce in just a bit from now. But first up, Nigel Surabhi, good morning.
Hi, Prashant. Good morning. And we're really looking forward to the insights that you're going to pick up from that conference today. And it's really important, right? Because I think markets here in India and around the world are trying to figure out whether, they should be looking at the economic issues or threats imposed by tariffs or looking through them and marching higher. This morning is that march higher across most of the indices.
Well, Prashant, looking forward to the feedback you're going to get from that conference, because yesterday at the BofA conference as well, one thing was clear: you threw any kind of bad news to the Indian markets, that's being gobbled into. But first up, let's hear your conversation with Jonathan.
Well, absolutely, guys. So, as I said, I'm coming to you from the sidelines of the Morgan Stanley Annual India Investment Conference, and I'm sitting down with Jonathan Garner, who is the Chief Asia and Emerging Markets Equity Strategist, one of the top equity strategists, really, one of the top minds globally. Jonathan, it's a pleasure to have you with us here. Thank you very much.
Yeah, thank you.
Thank you for doing this, and I think it's an annual ritual, and we're very glad to have you. So, Jonathan, what's top of mind? What is going to be top of mind? Let me sort of preempt that a little bit as you start and kick off this conference over the next couple of days. What is the one question you expect to hear the most from investors?
Well, we're very bullish on India. It's our largest overweight. And if you just look at the most recent quarter, 7.4% GDP growth, I mean, that is far and away the strongest of the major economies in the world. So I'm looking forward to hearing at a granular level what the companies have to say about the growth environment and how investors react to it.
So right there, top of the pack, India, for you.
Absolutely.
It has been for a while, right?
Yeah, we've been overweight India really going all the way back to, I guess, the sort of the COVID era. And if you look at earnings growth for MSCI India, which is the investable universe for the global clients, earnings is compounding in dollars around 12% per annum now. We're in the fifth year, really, of compounding at that rate. And though there have been some cyclical bumps along the way, there was in the second half of last year, again, that's the strongest dollar earnings per share growth, really, of any major market.
Jonathan, it straight away comes to valuations, and I think you get a lot of questions around that as well. So there are about 550 companies in India with a market value of greater than $1 billion. 300 of those now trade at over 40 times trailing earnings. I mean, 40 times trailing earnings, as you said, earnings growth of about 12%. That's the average, of course. I mean, some would be higher, some would be lower. Are valuations a problem?
Yeah, so I don't know about the top 500. The MSCI India is trading on about 22 times forward PE, which is roughly the same as the multiple on the S&P. But actually, the earnings growth here is faster than the S&P. Not necessarily the Mag 7 companies, but it's faster than aggregate S&P earnings in recent years. Return on equity here is around 15-16%. It's somewhat higher in the US. But really, the reason I'm comparing it with the US is it's a growth market in terms of earnings growth, and so it should be on a growth multiple. The markets that we tend to disfavor in Asia and EM are what we might term value trap type situations, or situations where they've been priced very highly, but the earnings growth is not really coming forward, or it might be more cyclical than investors expect. And certainly on India, last time I was here in January, there was a big debate about the cyclical slowdown at that point. Indeed, amongst domestic investors as well as foreign investors, concerns that after last year's elections, we might be headed for a sustained growth slowdown. And that was not our view, that of our economists and local analysts. And it's really good to be back here in May and seeing that the economy is reaccelerating.
And we got the latest GDP numbers, which were better than expectations. And I mean, I think those tax cuts, etc., will also start to feed through, show up in some way in terms of increased consumption. RBI is embarking on a rate cutting cycle, hopefully this Friday.
Yes.
And we'll see many more to come. So all these add into that view, Jonathan, right?
Well, that's right. I would also add that 10-year bond yields are very well behaved and moving lower at a time when in many other geographies they're not doing that. And that's all testament to this virtuous circle. If you're growing strongly and attracting domestic capital formation and inward foreign investment, you can have a strong currency, reasonably strong currency, but also well-behaved bond yields. And I would also mention that the volatility on the Indian equity market is much reduced now, which again affects the risk premium as foreigners would see it. It's trading less than half the volatility, for example, of a major Asian index like the Hang Seng Index, when you look at, let's say, sensex or the nifty.
And that is a big part of the pull, I mean, the stability, the low volatility in that sense?
Yes, it's a structural overweight for us, India. And again, that valuation point, which investors, if you're a growth investor, you're reasonably comfortable with it. If you're a value investor, you tend to be frustrated because you want exposure to India, but you're not going to get to buy it cheaply in this environment.
Jonathan, you advise institutional investors and you say, well, you're overweight India. Well, I guess local investors have been overweight, double overweight, triple overweight India for the last many years. And they're such a big factor for the resilience, the outperformance, the stability, etc., that you've spoken about. Those systematic investment plans, right? Every month pulling in record amounts, higher and higher amounts.
Yes.
And that's been a big part of all of it.
Yes, absolutely. And it's a very attractive feature of an equity market if locals are committing regular pools of savings into that equity market. And it's not true of some other large EM. They don't have that characteristic. In fact, there's an academic literature about this, that if you have a young middle class that's investing in equities, it tends to go hand in hand with performance, but also, as we've already mentioned, with relatively high valuations. So when you had that kind of demographic tailwind in Japan in the 1980s, that was a positive. Similarly, in the 1990s in the US.
Okay. So foreigners are going to commit more and more capital here. I mean, because we had a bit of late September or so, foreigners started selling, and to the lows that we saw earlier this year, about almost $25 billion went out in terms of selling. Many point out it is because of global emerging markets seeing redemptions, etc. It's not so much about India. GEMs as an asset class was getting outflows. What's your prognosis from here?
Yes, I think for every buyer there has to be a seller by sort of definition. So if you have a strong domestic bid, that will pull some selling down at higher valuations. But I would point out that there's a lot of IPOs that happen in India, secondary issuance, and so the weight in the EM index is constantly rising. It's the second largest market in the index now. And so what we're seeing is like passive allocations are building towards India, but also for the first time, non-EM dedicated investors who tend to maybe have more of a growth style bias are starting to get involved in India, because it's no longer within the tracking era for a truly global equity manager. It's around about 2.5% of the All Country World Index, which means that those truly global investors have to buy their first or second India stock.
And that's starting to happen, because I've heard it for the last many years that global funds have very little exposure in India. The big global funds have little to no exposure, and you're saying that's starting to change.
I think the last sort of 18 to 24 months, it's starting to change, absolutely.
And that passive point as well, it is a recent phenomenon. I've heard that elsewhere as well, that a lot of passive money is starting to come in.
Well, you're right that there were passive outflows last year from emerging markets generally, but now that the cycle in the US dollar has turned and the US dollar itself is starting to be structurally weak, we're seeing this kind of interest in investing internationally, in Europe in particular, where there have been very large inflows, but to some extent in Asia as a whole, Asia Pacific, and India's getting some share of that.
Let's just look at the other stuff, the big calls. I think your call is dollar will fall. The broader dollar will fall substantially. Is that the view?
Yes, we think on the DXY index, the broad trade weighted dollar index, it'll get down to around 90 over the forecast horizon. So that is a good sort of 9-10% decline from current levels.
And what's going to be the dominant driver for the fall there for the dollar?
I think it's a couple of things. The most important is narrowing of growth differentials in our forecasts versus the rest of the world. As I mentioned, we have India growing easily 6.5% or so. US growth is going to fall, we think, next year to around about 0.5. And at some point next year, not this year, next year, the Federal Reserve will cut interest rates. So we have a sort of a decline in growth differentials. We don't, for example, have European growth changing very much over the forecast horizon. But then also I think there is this issue that's appearing where for 15 years we've had very large foreign investor portfolio flows into the United States. And it's driven some of the outperformance that we've seen in US markets. And I think investors are now looking at the world. They're looking at their kind of political risk exposure more generally. They're looking at many different factors that affect portfolio decisions. And they're choosing to reduce somewhat their structural overweight on the US. Now, again, we have somewhat of a nuanced view here because for the US equity market itself, we do think that weakening dollar can actually help the earnings profile of US multinationals. Some of the mega cap tech names have very strong revenues internationally, so they can actually benefit there. So there's a kind of an interesting interplay there. We actually think that the S&P 500, for example, can get to 6,500. And that's a decent return in dollars. But for a global investor, you have to factor in the likelihood that the US dollar itself weakens. So if you're based in the Eurozone or you're based in Japan or Australia, you have to factor in that dollar weakening.
But growth in the US will not slow down substantially so as to hurt growth elsewhere as well. And then, I mean, some of the other assumptions don't come into a question.
It depends who you are. Obviously, there's the tariff and non-tariff issues that are going on at the moment. But if you...
Sorry, please go on.
It's not my phone. But actually, if you look at the situation in Asia, we've got GDP growth in our forecasts slowing in the more trade-dependent economies of Asia, for example, Taiwan or Korea. But for India, it's not that dependent on manufactured trade relations with the United States. It has a big services trade relationship with the United States, but that's not necessarily in scope for what's going on here. But it has very strong domestic demand drivers in terms of the urbanizing population, the formation of the middle class. And so actually, of all the geographies in Asia, it's the one that should most decouple from this decelerating growth path we have for the United States.
Got that. Let us talk a little bit about sectors here in India. Financials, I think, has been a big overweight for you for a while.
Yes, we like financials really across Asia, but particularly in India, because they're a sector that actually generates revenue growth directly from underlying domestic economic growth. And that's what we're seeing. And they can probably grow earnings somewhat faster than overall nominal GDP growth. So maybe trending faster than that overall 12% EPS growth that I mentioned earlier. But we also like in India industrials and consumer discretionary. So we've got a full sort of set there of domestic exposure. Where we're more cautious is on some of the, let's say, defensive sectors like staples or some of the sectors that actually trade in goods and services that cross borders, where the actual revenue streams that they get in US dollars, when you translate them back into Indian rupee, are maybe going to be less attractive because of the dollar weakening trend.
So financials, industrials, consumer discretionary.
Yes.
These are the big ideas. Within industrials, I mean, which sub-segments, segments?
Well, I was actually just reading, arriving here, reading the local press and catching up on what's going on in cement and on capex. Again, that was quite weak back end of last year. But those areas where our analysts have been upgrading some of the names, they look inherently interesting to us. So, both a government and private capex cycle. And all that feeds into that.
And consumer discretionary? I mean, any particular areas, really?
Well, I guess we're waiting to see around truly significant local brands. That's something that I covered a lot in China through its economic development as we develop local brands. That can be extremely powerful. The traditional areas to get exposure to are autos and two-wheelers, but the auto sector is relatively problematic at a global level, particularly around some of these supply chain interruptions in the EV sector and in price competition. So one needs to be a little selective, but unfortunately I can't go into the individual stocks.
With regards to what the central bank here will do and what the fiscal response really is going to be, I mean, you think, any forecasts really in that sense?
Well, we think 2 rate cuts, one likely this week and one in the second half of the year. And again, that's remarkable at a time when the Federal Reserve is not able to cut interest rates because of the initial stagflationary impact of the tariff and trade issues. So it is exciting to see lower short-term and long-term rates in India. That's very supportive of equities.
You know, just sort of pull back a little bit since we've talked about the micros. You said for investors, a lot of political risk exposure, etc., all that also has started to matter a lot more. And there is a lot happening. So what are the one or two big themes which come up in conversations with big global clients? And, you know, in the context of India, we always hear it's actually better placed than most in that sense. I mean, it's not really, there is this strategic competition between the US and China. Here in India, we kind of sort of, you know, we've been working with pretty much everyone in that sense. What is your sense, Jonathan?
Well, we're certainly in an era of hegemonic rivalry between the US and China, and our overall framework is what we call multipolar world dynamics, which we first wrote a Morgan Stanley blue paper on as long ago as 2018. So we've been talking about this for quite some time. And we did identify in that original blue paper India as particularly advantaged just simply because of its size and its history and its ability to forge relationships in this complex world with the other large powers. Now, that isn't always without tensions, and there are certain issues that can arise, particularly, let's say, vis-à-vis Russia, for instance. But those can be negotiated or dealt with as India deals with its relationship, particularly with the US and China, and that's what we're actually seeing. Whereas for some other geographies, some smaller geographies, they have basically been forced more or less by these developments to move decisively into one camp or the other, which reduces their optionality. So we would still emphasize, and did in our original work, that India is quite advantaged in this regard.
And it's played out like that, essentially.
Yes.
Since then, back in 2018 and what you've seen so far.
Yes, it has. I mean, one of the ways that you can sort of see that is that if you look at, say, FDI flows or private equity flows into India, they are very, very buoyant, and they come from, across the planet. They're not just coming from the United States. So I think this perception that we have is actually shared by many investors as they commit long-term capital.
And what is the sense about this shift away from, especially on the manufacturing FDI side, global MNCs setting up shop, factories building here in India? What is your feedback on that? Is that process underway? Because some say during Trump 1.0, countries, smaller countries like Vietnam, Cambodia, etc., benefited. A lot of the shift did not happen towards India. Maybe it'll happen this time. At least that's the hope. What are you picking up?
Well, if you look at the supply chain in smartphones or other areas of technology, it's certainly moved at some pace towards India. You're right that if you look at Vietnam in particular, it's had significant success. But India has probably outperformed some other geographies that have relatively low wages, for example, Indonesia, in attracting inward FDI. And certainly it's proceeding at some considerable pace.
Fair enough. And this shift will continue to happen over the coming, and that's the bet that many are making here.
Yes, and I think one thing that's important is, having seen this shift earlier in my career in relation to inward investment in China, which continually surprised on the upside, the reason that this is happening is not just for export, let's say, back to the US or Europe. It's to actually service the local market. And the local market, if your GDP, when we started this interview, is growing at 7.4%, that is highly attractive. So you have to have plant here at scale to service the urbanizing middle class, just as you did in China 20 or 25 years ago.
So it's not just a factory to the world, but it's essentially the large local market as well, which is the attractive.
Yes, and by setting up locally, if you're an inward FDI multinational, you'll inevitably get to learn more about local market, local tastes, and what the consumer wants, or how you can actually develop your supply chain, and all of those sorts of things that was going on in the southern part of China or around Shanghai in the past.
A slightly near-term question. India was said to be one of the first in line to get a deal with the US. I think various officials, including President Trump, have spoken about it. Not got there yet. You think it's going to take time? It's delayed for some... what's your reading of the situation?
Funnily enough, as I was just getting up and having breakfast this morning, Commerce Secretary Howard Lutnick was actually talking about the deal with India being relatively imminent.
Yes.
And we would still anticipate that India would be one of the first countries where there will be at least an outline deal done.
And an actual one, of course, takes a lot longer, a proper deal.
Well, if you look at
an agreement and then, of course, a deal later.
Yes, if you look at the United Kingdom, which has done an outline deal, that's sort of what we're talking about here.
Do you have an assessment of where tariffs in the US, by the end of all of this sort of, upheaval, up and down and pull, back and forth, is going to settle at? When President Trump came in, I think average tariffs are about 2.5%
Yes.
to 3%. They're significantly north of 10% now. Where do you think we will be by the end of this year, according to you?
Well, not lower than 10%. I mean, this is a part of industrial policy in the United States, and it also raises tax revenue. So it has those two planks that underpin the philosophy here. We think for most countries, it's going to be sort of lower than where we obviously got at the peak of the post, like, Independence Day announcements. But for China, it'll probably be materially higher than for the average country. So this hegemonic rivalry between the US and China will result in higher tariffs that both will have on each other by the end of the year. Whereas for India, we would expect it to be relatively low.
But average, at least 10%.
I would say at least 10%, not back to
China,
the number of 2
north
or
of
2.5.
30%, or
we have it at the moment running around about on a weighted basis across all the product lines. It's about 45%. It might end up somewhat lower than that, but maybe not materially lower than that.
What are the big risks, Jonathan, that you think about, which can sort of which can derail some of this?
Ultimately, we're investing in a multipolar world environment, which is inherently complex and risky, as we see. But again, I want to emphasize that point about volatility. I mean, we've had exceptional volatility again in markets this year. But India is not at the heart of all of this. India can get on with its own business and do very well economically and as a market.
I got that. Russia, Ukraine, for example, any thoughts on this recent escalation?
I can't comment on that.
Okay, fair enough. I mean, I think we've seen some developments over the weekend, but things to watch. It's a war which has gone on for 3 years with little impact, probably from a market standpoint. But we will maybe pick up on this later. Jonathan, we'll leave it there. Great conversation as always.
Thank you.
Thank you very much for doing this. Really appreciate it.
Yeah, great to be here in India. Thanks for having me.
Good luck with the conference.
Thank you.
What we're going to do is take a quick commercial break here. And, of course, we'll go back to our studios on the other side with Nigel and Surabhi. They'll take you through, of course, the setups and, of course, our research team with the top 10 stocks in focus. Stay tuned.
Welcome back. So you heard the big house view from Morgan Stanley come through with Jonathan Garner just a while back. Now, very quickly, let's look at the trading setup. The difference between yesterday and today is that overnight markets seem to be trying to take a lot of these trade risks in their stride. We've seen a positive close across Wall Street as well. The market managed to pick up from what initially was a 200, 250-point drop on the Dow. So there's some positivity there. But the headlines are still very murky, to say the least. Yesterday, by the way, the shares of steel makers in the US, they surged between 10% and in some cases 22% because of the protectionist measures that have been announced with the doubling of the tariffs. The EU, yesterday it was all about skirmishes with China on trade. Overnight it was about EU because the EU has said that the doubling of steel and aluminum tariffs, quote unquote, undermines the trade negotiations with the US. And that's not all. The European Commission is also talking about finalizing, countermeasures, expanded countermeasures against the US, which are set to go into effect by the 14th of July. It could be earlier, depends on how the negotiations go. Very quickly, in the crude markets, there was a big move, 3% move on crude last night. I mean, this time, if you're looking at prices on the screen now, we've got Brent around 64, 65. This is because the production increase that's been announced by OPEC Plus, it's a little more gradual. The market was worried that it'll be a very quick uptick in volumes, but that's not the case with the kind of increase that they have announced. Coming to Asia, most markets are in sync with what we've seen around the world. There's plenty of green on the screen today. Look at the Hang Seng, for instance, up about 1.5%. But again, watch out for headlines here as well. You know, the trade issues seem to be playing out in growth. We've got the Kaishan manufacturing numbers. PMI numbers out of China this morning, very, very weak because that number for the month of May is at 48.3. So it's in, the negative territory. There's contraction happening on the manufacturing side. And it's the fastest pace of contraction since September 2022. So, Nigel, I guess some of these trade issues, they're beginning to bite. But let's see. Flows have been mixed for us, and our market has been more or less consolidating, right?
Well, that's right. You know, if you look at yesterday's intraday chart as well, the market wants to be bought at around this 24,500, and it's telling you that because yesterday, you know, the kind of cues you had every reason to pull back a little bit, but actually the kind of recovery we saw from around that 24,500 was considerable, which is very, very good. And what did the FIs do in yesterday's trading session? Well, on the future side, on the index futures, they have gone ahead and they've added some short positions. So even in yesterday's trading session, they added close to around 5,000 short contracts. While the clients, well, they are sitting on net long positions. And yesterday, it was more or less stable at around 62,000 contracts. So both of them at opposite ends. That's the combination that you actually like. Now, going by the data points that we have and going by the options data as well, we seem to be in this broad 500 to around 600 point range. On the downside, 24,500. On the upside, 25,100. Resistance just for today comes in at around 24,950. I'm calling out this level because the 24,700 calls for a fair bit of addition. The premium there is roughly around 220 rupees approximately. So that's why resistance comes in at around 24,950. Support though, since we went closer to around the 24,500 mark, that becomes a bit of a support just for today's trading session. Remember, the 20 DMA now has moved to around the 24,700 odd mark. The key to track will be the Nifty Bank. It's very, very close to that 56,000 odd mark. It's not been able to conquer that. Yesterday, we went close to that mark as well. Decisively conquering this mark starts the next leg up. I've been saying this for the last 45 days or so. We've not been able to conquer that. We're very close. You'll want the Nifty Bank to go past that. So that's the index I'll be tracking to, pull us ahead from here on. And also, I'll keep an eye out on a stock. The stock that I'm looking at actually is Hindustan Zinc because silver prices have spiked up. They have a fair exposure to silver out there because it's a byproduct of zinc as well as lead. So I'll keep an eye out on Hindustan Zinc because it's the only listed play that you have on silver. So Hindustan Zinc is a stock that I'll track. That said, let's focus on all the top stocks we're tracking for you today on a special top 10 segment. The list of stocks will be coming up as we speak. And Rima joins in first to tell us about Emphasis. Negative news flow yesterday, but they've come in there and they've clarified on that. Rima, tell us more.
Indeed. So if you remember yesterday, we were talking about the Mint report, which said that FedEx, which is one of Emphasis' top clients, has lost its client to Accenture. Well, to that, in a written communication to the Bombay Stock Exchange, Emphasis is written, and I quote, "As a matter of policy, we do not comment on speculative news articles or on individual client relations and clients. However, for the sake of clarity, Emphasis continues to be a service provider in the FedEx ecosystem." So that's the statement. Emphasis continues to be a service provider in the FedEx ecosystem. Other aspects of the report are fairly speculative. The management reiterates and stands by its outlook. Yesterday, stock was down about 2.5%, perhaps some relief today.
All right, so Emphasis is going to be on our radar for sure. Rima, thank you very much for that. Let's move on, say hi to Vivek. Vivek, you're watching out for Torrent Power. What's the news here?
Well, good morning. So Torrent Power is in focus. This is a routine business that the company conducts every year. So what the company has done is they've signed a long-term sales and purchase agreement with BP Singapore. The change here is this time around they've gone in for a long-term supply agreement. So the company will be going ahead and procuring close to 0.41 million metric tons per annum of LNG. And this particular deal is from 2027 to 2036. So now this particular LNG that the company will be procuring will be used to operate close to 2.7 gigawatts of gas-based power generation capacity that Torrent Power operates. Along with that, Torrent says that it will also be used to go ahead and support the city gas distribution business that Torrent Power operates. Along with that, the company says to make or to take advantage of the softer LNG prices, they are further exploring medium and long-term LNG procurement, and this, they believe, will help support the group plans going forward. So Torrent Power expect a slight gain on the stock today.
Okay, all right. Thanks a lot for that, Vivek. Well, let's hop across to Ekta. She's here to tell us about Glenmark Pharma and Biocon. Ekta?
Well, I'll start with Glenmark, where their innovation arm has presented phase 1 results for a drug which is under development, ISB 2001, at the American Society of Clinical Oncology, which is one of the biggest forums for oncology in the world. ISB 2001 is focused on multiple myeloma. The company says that across 35 patients that they treated, the overall response rate was 75%. Remember, this particular molecule was granted fast-track designation status by the US FDA in May 2025. 5 orphan drug designation in July of 2023, and they have said that they are in advanced discussions with multiple partners, all big pharma. Biocon in focus because they've received approval for liraglutide in India. It is a GLP-1 drug. And the company says that GLP therapies such as liraglutide are expected to be key future growth areas for Biocon. Remember, they've already launched it in the UK. Important to note that there are better molecules out there which are used for GLP-1 or used for this particular condition, such as semaglutide and now Mounjaro's drug. So liraglutide, while it's positive, it's not the the biggest drug that they're watching in GLP.
Okay, all right, Ekta. We'll watch out for Biocon nonetheless. Thanks very much for the context and the details over there. Let's move on. The next one on our radar. Actually, Nigel, let me ask you, Man Industries, what's happening here?
Well, that's right. Man Industries first, Surbhi, if you just look at the last 1 month, you'll see that the stock is up more than 40%. Clearly the street was sensing something. And yesterday you got that announcement that came. In fact, 50% in the last 1 month or so. They've gone ahead, they've announced a fundraise. 300 crores is what they're raising. Through the promoter entity, they're going to be raising close to around 40 crores approximately. That's going to be via convertible warrants, which will be convertible in the next 18 months or so. So promoter, they're putting some money out there. And the non-promoter as well, they are going to be putting close to around 260 crores. That's via equity shares. And the list comes up for you. Some of the notable investors include Mr. Ashish Kacholia as well. What are they going to be using this 300 crores for? The ongoing capex. Remember, in Jammu as well as in Saudi Arabia, they have a capex. They have some working capital needs as well as balance sheet strengthening and the company's long-term goals as well as some strategic initiatives. So the news is positive, but just keep in mind that the stock has seen a big run in the last 1 month or so. And, the pricing that it's being done at is around 328, which is the discount to yesterday's close price. Going with green, though, on this one.
Okay, so Man Industries is going to be on our radar as well. Let's now also talk about crude because the kind of move that we've seen overnight, perhaps it could impact stock prices as well. We have Manisha joining in. Manisha, good morning. Quite a surge. 3% last night, right?
Oh, yes, it is 3% of gains in the overnight market. And, there have been a lot of factors which clearly have been supportive, beginning with OPEC and allies, which have keeping the output increases in July to 411,000 barrels per day. It is on the higher side, but the point is that there are no surprises here. This is the number that the markets have digested, has been talking about as well. And then Iran seems set to reject the U.S. nuclear deal proposal that added to the premium. The Canadian wildfires have just about continued, hitting 7% overall country production. So some supply concerns coming in from there as well. And U.S., the rig count has declined for a fifth week to the lowest since 2021. So all that, the immediate tight supplies into the international market is what seems to be supporting. And having said that, the peace talks between Russia and China have failed to yield substantial progress. The U.S. and China conversations also seem to be going downhill. The decline in dollar index also has been supportive. So everywhere that you see, there are very, very strong supportive factors continuing for the crude prices.
Okay, all right, Manisha, thanks a lot for that. Well, here's a quick recap of all the top stocks that we're tracking. We just listed out for you the ones with positive news flow: Emphasis, Torrent Power, Glenmark Pharma, Biocon, Man Industries, as well as ONGC. While stocks with negative news flow include the likes of Aptus Housing, Zinca Logistics, Asian Paints, as well as Berger Paints. We'll take a short break, but on the other side, we'll be focusing on the stock of the last week or so, Welspun Corp. They're going to be joining to detail their Q4 numbers and the outlook as well for the next year. Stay with us. Welcome back. You're tuned into Bazaar Morning Call. Well, as promised, Welspun Corp, that's a stock on our radar, reported a solid showing in Q4. The EBITDA coming in at the highest we've seen in the last 5 quarters. They have also surpassed the guidance that is set out for the last couple of years, and they've given a healthy guidance going ahead on the EBITDA front. We have with us Mr. Vipul Mathur, the MD and CEO of Welspun Corp. Hi, Mr. Mathur. Congratulations first on a solid showing. And thanks a lot for coming down to detail your numbers.
Thank you, Nigel. Thank you very much for inviting.
Let's get a couple of aspects out of the way before we focus on your numbers. Over the weekend, we got news that President Trump now is talking about tariffs going up from 25% to 50%. You all have your manufacturing unit in the United States. So will this be an incremental positive? Will pipes as well come under this steel and aluminum that you're talking about?
So if you look at our order book, at this point in time, I just want to put some clarification. We have an order book of close to, let's say, 19,500 crore rupees.
Yeah.
In that order book, there is not a single 10 or single value of an order which is going to get exported or getting imported into US, where it will be subjected to tariff.
Okay.
So
you're absolutely secure from
I'm
that
absolutely
standpoint.
secured from a tariff perspective.
Yeah.
All what we are doing, we are producing there in America. We are buying the domestic steel, producing locally and supplying locally. So to that extent, we are completely insulated. One. Two, this tariff, if, as Mr. Trump is talking about, I think so it is going to be beneficial in the long term. And, we have also evaluated that, to be honest. And that is the reason we are seeing that in times to come, that is an economy where domestic protection will be, much higher. And that is the reason we have announced about a sort of an incremental capex in the US economy.
In the US. So just to understand, and you were explaining to us, in the break, that 30% of your revenue currently is coming from the US. If I talk about your total production, how much is production happening in the US? And the worry there is, I'm not sure how you're sourcing the raw material. Because if that steel has to be imported to make the pipes, then, will that not incrementally cost you more because the tariffs are now going to be increased? Or is there ample steel available locally in the US so it doesn't really impact you?
So a very, very large part of the steel is locally available there in the US. Very, very large part of it. I mean, there's a very minor portion of it, which you probably have to import from. So the impact of that is very, very minimalistic in nature. But, largely it is domestic steel.
Okay, all right. Just one more question with regard to the capex. You'll have a HFIW capex for a long time. You'll have a unit in the United States. But in the last 6 to 8 months, I've seen you're putting on some aggression. Now you'll have announced this LSAW pipe. And you'll have announced capacity addition as well. What was the trigger? President Trump putting in these tariffs, do you believe that the US is seeing a longer runway in terms of, setting up these pipes and these facilities? If you could give us some clarity on that front. And also the LSAW pipes, you're putting in close to around 1,000 crores, I think so. What is the revenue potential and margin out there?
So two things. Number one, as regards HFIW, that's more of a capacity enhancement, right? We were there in the HFIW business for a very long time.
Yes.
We are seeing that there is a shift which is happening into the market where the pipe requirements are going to get even more stringent and extreme.
Okay.
Our existing capability was unable to address that. So we thought of enhancing our capability. Let's say, we were not able to make 24-inch pipe. We were restricting up to 20-inch pipe. The way the liquid lines are now going to, a liquid network is going to get created in the US, the distribution network, they will require a lot of 24-inch pipeline. We are seeing a lot of business coming up in times to come for hydrogen and carbon capture, and they will require very heavy wall thick pipe. So our existing capability was unable to address that.
Okay.
So this investment, what we have done in the HFIW has to be seen more from a capability enhancement point of view. Okay. Coming back to the LSAW part, typically you are seeing US is positioning themselves as a net exporter, both for oil and for gas, and largely for gas. We are seeing a huge shift happening in terms of putting up new LNG terminals and all that stuff, right? And we are also seeing an incremental activity which is now going to happen in Gulf of Mexico. My apology, Gulf of America.
Gulf of America.
Gulf of America.
I have to be careful.
I have to be very careful. So we are seeing incremental capability or capacity going to be built up over a period of time. Now you link it with the tariff. Now, there is no import which is going to come in. Earlier what was happening, these, when you talk of LNG terminals and when you talk of Gulf of America offshore drilling, they required heavy wall thick pipes. And they were predominantly LSAW pipes.
Okay.
So a significant quantity of that was being serviced locally, but there was also a large quantity which was getting imported from there. And imports were coming primarily from Europe or from Southeast Asia because they have the quotas. Now, everything will go behind that. Now, all of that will get shut down. So there will be a space which will get available if someone is a local player. Today, as Welspun, we are the largest line pipe manufacturer. I have a 30% market share and it is increasing. There is no better company than Welspun to position themselves into the LSAW pipe. And that was a rationale for us to put a new investment in terms of LSAW pipe.
Got that. So you're looking to fill in that vacuum that was coming in from imports, and you're still seeing that there's a structural story that's playing out there. So that's why you're setting up this LSAW facility. A couple of numbers, sir. Revenue potential from this facility when it gets commissioned in the next 18 to 24 months, and what kind of EBITDA? You've told us in the past, US gives better margins. So if you could give us a rough number.
So let's say from a capex perspective, it's almost 1,000 crore rupees investment. From a timeline perspective, it is something like 15 to 18 months, but most likely towards 15 months. And in terms of top line, see, we expect to do close to, let's say, 150 to 200,000 tons of the market we want to capture. Okay. Right? And, top line is a multiple of what is the prevailing steel price and all that.
What is it right now?
So, let's say today's steel prices would be close to $1,400, $1,500 steel price, but the pipe price will be close to $2,000. Let's put it this way.
That's your spread, yeah.
So, the top line is getting determined out of that. Yeah. Okay. But coming back to the EBITDA, the earnings part of it, I think so. This is a high remunerative market if you look at it, and it is fair to assume something around 12 to 15% of EBITDA on a is a safe assumption to have it. But we will have to see how things pan out. We are very optimistic about that particular market. We are seeing a huge growth for the next 5 to 7 years' time, right? And we are seeing a massive, oil and gas investment going to happen in that particular country. Despite all that what is being discussed around, we still feel we are very optimistic around it, and thus this investment.
At the back of an envelope calculation, it appears you're going to be putting 1,000 crores, and at current prices, if I take $2,000, per ton, and 150 to 200,000. Looks like you'll do close to 3,000 crores of revenue potential from this capex. Is it ballpark the right number?
That's a fair point to assume. That's a fair point to assume.
So the US business is really fighting for you, and you're clearly in that sweet spot because of your manufacturing facilities there, that you're benefiting from the protectionist tendencies. That part is very well understood. Overall, I think for the year, you're guiding for 18% rise in EBITDA. So just throw some light also on the India business, because the revenue mix will change. It'll be more US, but there's a large India operation as well. So just tell us about what gives you the confidence of achieving, I think, Nigel, 2,200 crores, right, is what we're expecting for this year. So just walk us through, how you've...
So
and will you outbeat that? Because last 2 years you've been doing that.
You've been outbeating your own guidance, so yeah.
We'll come to that. So two factors to that. One is the healthy order book. If you look at it, it's a 19,000 plus crore rupees of a confirmed order book, what we have at this point in time. A large part of that order book comes out of our US at this point in time, right? So, the profitability is reasonably better than in comparison to the other geographies. That's one part of it. So, we are confident that, there would be a uptake on the EBITDA numbers and the percentage as well. If I talk about the India business, our India business, has two components to that. One is the oil and gas component, other is the water component. Water component is steady state. It's, it's going on nicely. But the oil and gas component is also giving us a lot of benefits. Today we have plants which are almost booked for more than a year. The signature plants, the ELSA plants, what we are talking, which where you get the highest margins, highest EBITDA. So they have a clear visibility of more than business for more than 1 year, and more than that, a clear visibility of another year. So I think these are the factors which are giving us the confidence, and that is the reason we have been able to put this guidance that we should be able to give you, we should be able to deliver a bit of 2,200 crore rupees.
And you all calculate with the other income. The chart is telling you, will you outbeat what you put up? Last 2 years, we have that chart that you have outbeaten. Probability that you're being conservative at 2,200, or you like to stick to 2,200?
The way, see, this is a project-based business. There are many variables which are out there and which are beyond your control. So, I will admit that we have to be conservative because there's many variables which you don't control that.
Yes.
And, how they will pan out on a quarter-on-quarter basis. And we are seeing that what are the changes which are happening. Yeah. So, we are very confident to deliver this. Okay. Outbeating, I'm sure that we'll talk about maybe after Q2.
One of the variables that the streets gets a little bit skittish on is the crude oil price movement. So, can you clarify? At what price does some part of this order book become uncertain, or do you think that, that there's no uncertainty? Because in the past, we've seen some uncertainty when crude oil prices see a sharp dip. So you want to give us a level of crude or something that you would like?
It's a concern. Yeah. There's no doubt about it. See, we cannot ignore that, crude pricing is not a concern. It is definitely a concern. There's no doubt.
At what level you're comfortable, though?
See, what we have seen in the past, Nile, that when it comes around $40, $45, that is where we have seen a sort of a slowdown which is happening, number one. Number two, we also have to see that, this business, when the E&P companies look at this business, they do not look at it on a short-term basis. They see a horizon of 5 to 7 years' time. Because when they roll out their capex plan, which is multi-billion dollars, they do it over 5 to 7 years' time, their planning part of it. They don't do it on a short-term basis that tomorrow it becomes 45 and tomorrow it becomes 50. And, they just can't do that. They can't do that. So their horizon is much lengthier.
But roughly you're saying $45. If crude crashes to as low as that, then it becomes a concern.
Then it becomes a serious concern. Then it becomes a serious concern.
Just quickly on the capex you're putting to work as well. I think it's almost 4,400 crores that you're putting to work. Just walk us through the debt levels right now. Where will debt peak out and what do you see ahead?
So typically you see the capex is split over US and our Saudi investments, right? US, we have talked about 1,000 crore rupees of investment which is going to happen. And then, we have also upgrading this HFIW bill. the second investment which is happening in Saudi. So that is where almost 1,600, 1,700 crore rupees investment is happening. So these are the two large geographies where the investment seems to be happening. One of them would start coming on upstream in 27, right? And we would see the trickling of their cash flows, trickling income to FY27. And from the US, we'll start seeing trickling in FY something like 28. So if you see the trajectory, what we are building at this point in time, we have a confirmed order book of FY26. We have a clear visibility of FY27. Yeah. We are now putting about to next platform that the new geographies, which is the Saudi, will start trickling in FY27. And then by the time they will stabilize, we will have the US geography FY28 coming in.
What's the debt level now, debt equity?
So right now, we are a net cash company at this point in time. And, if you look at this year, we still have a net cash of 1,000 crore rupees, despite doing a capex of almost close to 900 crore rupees in this particular year. Moving forward also, I think so we are very clear that our net debt to EBITDA, we will be able to maintain less than 1. Currently, we are striving to be a net cash company, even in the 2 consecutive years where we are going to do the maximum capex.
Okay, all right. Final question before we let you go. The OPVC pipes, that's the big launch, Syntex and scaling up out there. If you could tell us for FY27, what kind of an EBITDA contribution can come in from this, the pipes division and the Syntex division, because that's where the ramp up and that's what the street is hopeful of an optional value coming out. And the other smaller part is the Welspun Specialty Steel. That's the other listed entity. Can you do a EBITDA of around 150 crores by FY28 on both these two? Because these are the optional value that comes out from it.
So let's say Syntex OPVC is going to be a game changer. We are very, very bullish on that, number one. It's a revolutionary product. It is going to which is coming to our stable. And we are very, very, focused on that. Right now, as we speak, we are about to start in Bhopal. We have 2 lines put up in Bhopal, and then we are moving to Raipur, and then we will move to South. So that's our plan, that we will eventually start with 6 lines over the next, let's say, 9 to 12 months or 15 months' time. And we see a huge traction coming in for that. I think so there's a lot of work yet to be done. But we are very, very confident that, we should be able to crack through. And given the situation, given that we are into a B2B space, we are dealing with the same customers, we understand this pipe market very well, we should be able to turn around that very fast. A little early to give in terms of EBITDA numbers and all that stuff. I think so as we ramp up, probably in next 1 or 2 quarters, we should be able to crystallize those numbers, that what is that going to be. But in terms of our confidence, in terms of rolling that OPVC out, and in terms of its acceptance into the market, we are very, very confident.
And the smaller one, Welspun Specialty, can you do 150 crores in the next 3 years? Currently, you're doing only 50 crores.
See, it's a great business to have. It's a very, very great business to have it, number one, right? It is now, earlier, it has 2 components. It had a domestic component and it has an export component. We were a large exporter to Europe. European market seems to be slightly depressed at this point in time. So all what we are currently focusing is on the domestic market, and there's a huge upside and a huge potential out there. I think so, I don't want to put any numbers, but year-on-year basis, I think so we will see an incremental EBITDA coming up out there.
Okay. All right, Mr. Mathur, appreciate you joining in. You have seen various cycles of this business, some uncertain times as well. For the time being, the street is bullish on the prospects, but as you said, it has many variables. 2,200 crores is what you're going to be working with. You want to keep the books light as well. Look forward to chatting up with you.
This is the time for growth. I would say that in these uncertain times, you have to find an opportunity. So we are doing that, and we are very confident of that.
Fantastic. Okay. Good luck with your plans.
Thank you very much.
All right. Thanks a lot. Well, we've run out of time on this interview. For the time being, we slip into a break. Come back. The technical experts waiting for us on the other side.
Welcome back. Like we've been telling you, most of the markets across Asia are actually higher. Let's pull up the implied open as well. The gains range between 0.5% to about 1.5%, depending on which market you're looking at. That's a modest start that the implied open is indicating right now. Sudarshan Sukhani and Mitesh Thakkar with us as always. So let's get some perspective on today's trading action. Gentlemen, good morning. Great to have you on. Mitesh, what's your reading? I mean, markets are in a better mood this morning. This green across most global screens at least. Nifty, Bank Nifty, what's the trade?
Good morning. So, been maintaining a range-bound kind of a stance, and I think that still looks to continue. Though I think towards the closing session yesterday, there was a mild signal of indicators turning up. So let's see if we can build upon the mild gap of opening which the GIFT Nifty is showing. In case we see momentum coming in, the Nifty starts getting past 50, 70, 80, 100 plus points, then we might even explore an early long position. On the upside, 25,050 in the spot is the key level. Once we start getting past that, then we'll see a continuation. But at least till that, I think the intraday up move could sustain. So I think for the timing, I'm maintaining a sideways bias, but a strong opening followed by some good buying can actually, suggest to take a look at some long positions.
Okay, got that, Mitesh. Sudarshan, what about you?
Yeah, good morning. See, yesterday the idea was to buy a sharp dip towards 24,500, 600. That dip happened, and the point there really was that 24,500 acted as support. Now, a small uptrend has started when the markets found support and started a rally. That uptrend should continue today and hopefully for the next 2-3 days. So it is possible that we may eventually lead towards 25,000. That's the view I have. So the trade is, if you are long, stay long. Otherwise, today, look for very small intraday dips to buy. Your stops are 24,500 and you have to be patient. Don't make it an intraday trade. Look for the next 2-3 days. That applies to the Nifty and the Bank Nifty both.
All right. Got that, gentlemen. Let's also talk about then stocks. Sudarshan, morning. What would you work with today? Buy or sell or both?
Well, it's actually mainly buying. The view is that the market should be cheerful, and if you see, Surabhi, the small caps have suddenly started, sort of growing up all of a sudden after many months of being in moribund completely. So small and mid caps are the focus. Dabur is a buy with a stop under 474. Indian Hotels is a buy with a stop under 769. Britannia is a buying opportunity, stop 5,500. And IDFC First Bank is a buy with a stop under 66. Different sectors, all mid caps, and that's the area where we should focus on.
All right, got that, Mitesh. Let's come to your stocks as well.
Yeah, I have an all-buy list. Couple of banking names featured over here. AU Bank was a BTSP. I think now can be looked at upon as a trading bet. Keep a stop at 706. Look for targets in the range of 745, 750. Federal Bank is a buy with a stop at 203.5 for targets of 213. CAMS is a buy with a stop at 40.80 for targets of around 42.40. And Angel One is the final buy call. Keep a stop below 3,100. Look for targets of 32.50.
Okay. All right, gentlemen. Got that. Thanks very much. We'll come back to you closer to market opening. Right now, have to take a very quick break. Come back. We'll, of course, have the pre-opening rates with us. And also, we get a discussion going on the insurance sector. The fourth quarter earnings season has been pretty okay for most of the insurers. So are there any interesting stocks you can pick? We get you a view from Kotak Institutional Equities. Welcome back. Well, just about 19 minutes to go before we get to today's market action. But as promised, let's try and understand how the fourth quarter earnings season has been for insurance companies. Many of them, like I said, have come out with better than expected numbers. So what is the prospect going forward, term, whether you're looking at life insurance or health insurance? We have with us Nishant Chawate joining in from Kotak Institutional Equities. Nishant, thank very much for joining in. And I want to start there with the basic summary of Q4, because many of the companies, especially the life insurance companies, delivered better than expected performance. You think it's sustainable? What's the takeaway? Because the anticipation seems to be that margins for these insurers should get better as there is an increased uptick in the non-par policies. Your thoughts?
Yes, I think definitely. If I kind of, look at the entire year, this was like a year of two halves. First half was a period in which your growth was very strong. Second half growth kind of tapered off a bit. There were certain change in regulations. At the same time, I guess the demand for unit-linked policy softened a little bit towards the end, and maybe that was the reason. I think as we move into the next year, what we are really looking out is the fact that with the upward sloping curve, or more importantly, bank deposit rates going down, probably the offtake for non-par policies or all kinds of traditional policies will probably tend to go up, which will help margins to some extent. In terms of volumes, you might be slightly weaker for some of the companies which had a higher base in the first half of the year. But to be very honest with you, that is anybody's guess. Again, unit-linked policies would probably be a little weaker. I don't know. We'll have to see how the market goes. But that could be one of the reasons why there could be a little bit of a weakness in the first couple of months. Having said that, we should be still in for a decent, kind of a mid-teen sort of a growth is what happens.
Okay, all right. Hi, Nishant. Good to see you in. Nigel on this side. So on the APA growth, you're saying mid-teens growth is what you're working with for FY26? Because if I look at FY25, growth, APA growth moderated and margins took a hit of around 30 to around 300 basis points. But now the ULIP contribution could move down. Non-par could do better, which in turn will help margins. So what are you working with for the coverage universe first in terms of APA growth as well as on margins?
So the way I would put it is a VNB growth closer to mid-teens, and AP growth probably slightly lower that, and a function of maybe margins inching up a bit. What quite a few companies have been guiding is that there is a fair amount of focus or investment that's going in adding branches, growing the franchise, because of which probably you may not be able to see as much of margin expansion. But that's fine. I mean, that gives you better visibility for long-term growth. So, it's that there are a lot of moving parts in this, very difficult to pinpoint. We'll have to see how the overall investment environment stabilizes, whether it's going to be a ULIP-driven year or whether it's going to be a non-par-driven year. And we'll take it up from there. But the limited point is that, I think in either of the products, there is some kind of a demand or buoyancy. So it should be reasonably good. The other thing also is that on the pure protection side, many of these companies have done well. They have been very successful in blending unit-linked policies along with more of term, or basically increasing the sum assured, which kind of is very accretive for margins. At the same time, I think on the credit protect side, which is essentially insurance policies which are bundled along with loans, as loan disbursement probably picks up from a lower base, maybe there could be some kind of uptick over there, maybe towards the second half of the year.
So those are lots of tailwinds, and absolutely, Nishan, take your point. I think the penetration of term insurance increasing is very heartening. I mean, it's one thing that works well for the company as well as for obviously the policy buyers. So that's good. Now let's boil this down to where one should invest. I mean, largely, do you have a preference between the general insurers versus life, or is it an across-the-board good year? And within that, how would you distill down? I think HDFC Life is one of the stocks you like. LIC's come out with a good performance in Q4 as well. So just run us through what your top bets would be and why.
Sure. So, we generally prefer, life over non-life, given the fact that this is a more stickier business, longer tail, and more importantly, a difficult business to kind of penetrate. Non-life tends to be a mixed bag at all points of time. In terms of picks, what we like is HDFC Life in the insurance space. We like LIC as well, given the way valuation gap has emerged, especially after rally in equity markets. And in the non-life side, obviously ICICI Lombard's is pretty well placed at this stage. On the non-life side, I guess we have a little bit of concern in terms of the way motor vehicle sales will play out, which is, I guess, as you know, motor is a large business for these players. But it's like the pricing on the commercial side seems to be strong. So that's something which will probably give some tailwinds to the business this year. But yeah,
all right, Nishant, very quickly, before we let you go, the big cue we're looking forward to later this week from a market perspective is going to be the RBI rate cut. And NBFCs, as a percentage of their borrowing mix, I think 30 to 60% comes in from banks. So they'll get some kind of leeway on that front. Which NBFC is best placed? And if you could give us your top pick from the NBFC or the HFC space, because they'll get some kind of benefit. Lower cost of borrowing. Hopefully they can, that's what will help them a little bit in terms of growth, market share as well. Your take.
I think what you explained is quite well, that, given the fact that as rates come down, we're expecting rate transmission to be pretty swift in this year or in this cycle, basically. So we're not building in large margin expansions. But yes, I think as rates go down, it probably helps them to compete better and maybe trade a little bit of margins for growth. So that's what could work for them. In the larger names, we do like Shriram Finance, and we do like a lot of affordable housing names, including Aadhar, Home First, Aptus, and some of the business loan companies like Five-Star.
Okay. All right, Nishant. Thank you very much. Very, very helpful conversation. Gives us a lot of perspective on what lies ahead, perhaps, for some of these insurers. Thanks for joining in. You have a great day. Okay, rounding up at 9 a.m. and we have a big story to address. By the way, the pre-open rates have started trickling in, 60 points higher on the Nifty. That's also on the table. But let's address this big story coming in from the telecom space. Vodafone Idea is in focus. The government is perhaps not looking at considering any further relief for the company when it comes to its AGR dues. Ashmit is joining in with more details. Ashmit, morning. Tell us.
Well, clearly, the government, Telecom Minister Jyotiraditya Scindia, in the statements that he's given, he's clarified that, look, the Supreme Court has ruled on the matter. That is the end of it, that there's nothing on his table that will allow him to go ahead and to grant AGR relief. And mind you, this is consistent with what CNBC-TV18 has been reporting. CNBC-TV18 was the first to report where a submission had gone from Vodafone Idea to the Department of Telecom, asking for some relief, asking for a waiver of the interest and penalty dues of the AGR. However, at the time itself, in response to the letter, DOT had clarified that, look, in light of the Supreme Court judgment, our hands are tied. We cannot consider this relief. Subsequently, we had Vodafone Idea moving the Supreme Court. And there again, for a second time in tow, the DOT again, by way of the Solicitor General, clarified once again that our view is clear, that the Supreme Court judgment makes the position clear. There is no room that is available for grant of relief. And on the basis of that, we had understood that the Apex Court went ahead. It had dismissed the application altogether for grant of waiver. It had clarified that, look, it is shocking that this petition is being filed despite the fact that the Supreme Court has already given the AGR judgment, that this petition is entirely misconceived. And on the back of that, even that petition being dismissed. So that dismissal of that petition by Vodafone Idea now being cited by the Telecom Minister Jyotiraditya Scindia, where he's clarifying that, look, the Supreme Court has had the final word. Our hands are tied. No room available, nothing on my table to grant any further AGR relief on the waiver front to Vodafone Idea.
Okay, all right. So the situation seems to be getting a bit dire here. Ashmit, thanks very much for getting us the context over there. Let's go across to Rima as well. Rima, morning. So what are brokerages saying now?
Before that, I just want to highlight that there is a potential block deal one should watch out for today. What we've picked up is that Ericsson, which approximately has a 0.9% stake in Vodafone Idea, is likely to sell down. If you remember, Ericsson is one of the vendors to Vodafone Idea, and they had acquired the stake in June of 2024 when Vodafone Idea had issued shares to Ericsson in lieu of their outstanding dues. So this is a potential. This is not that we've got the sheet from the bankers, but you should watch out for a potential block deal. Now coming to the brokerages, well, it's a mixed bag. Some of them still hold out faith that some relief is coming in. So let me run you through. Ambit say we remain buyers on hopes of a supportive government stance, but investors looking for lower risk upside exposure to India's telecom tariff resets should consider owning Bharti and Industar. So basically, Ambit has a buy, but they're saying it's a risky bet. So if you want risk-adjusted return, then you've got better alternatives. IFL, on the other hand, has a reduced call. Their target price has been 4% and unchanged even after the recent developments. On the flip side, Citi has been aggressive on Vodafone Idea, but they've brought down their target price to 10 rupees. CLSA outperformed, target price 8 rupees. So some investors, sell-side analysts, are still holding out faith of some sort of a relief coming through on Vodafone Idea.
Okay, all right. Thanks very much for that, Rima. Let's actually discuss this further. We've got Prakash Diwan joining in. Prakash, morning. So from what it appears, the court said nothing's happening. They've struck down and thrown out multiple pleas that have been filed. And now the minister in this interview seems to be indicating that the government's hands are also pretty much tied and there doesn't seem to be any relief. And the government's made this point that they're already owning 49% equity in the company. They're not looking to convert more dues to take that stake above 49%. And it ties me back to what, Vodafone Idea had said. They said that it's pretty much the end of the road if there's no further relief coming in. How do you view the current developments?
So it is definitely getting a bit dire, as you rightly said. The clouds are getting darker. But, I go back to the prime objective that the government put equity for in the first place, and that was to let Vodafone run along as a third player in this space. And now, of course, it's 3+1 because of BSNL. So at some point, the government also, of course, the government, I understand, is restrained from converting further equity because then they would end up owning a company in a majority stake, which is not what they would want as a fiduciary responsibility as well. So I understand that, and the relief could probably will have to be worked out in some other creative way, not just a conversion to equity. The big problem that Vodafone is trying to find solution, Survey, is on the debt side. The banks are not willing to give any kind of support on the debt side, and that's what's hampering any kind of a restructuring that they would want to kind of go ahead with. But let's see, there could still be some hope, and I do agree there could be some way where it can get salvaged to continue serving that objective of being that third player in a market with otherwise. And remember, the minister also mentioned that he's more concerned with the service quality of the customers rather than what a company does to survive, and that's the job of the company management. So, which is rightly put. So we'll wait for further developments.
Okay, all right. Prakash, so just to get this clear, you won't be a buyer on Vodafone Idea. Yesterday I was at the BofA conference. I spoke to Sachin Salgankar, and he was giving me rationale that he believes this is not going to be a duopoly market. It'll be a three-player market. So you're saying there is that hope out there, but you rather not invest and you stick to the core telecom players. Is that correct?
That's right, Nigel. So while we understand that Vodafone could continue to be a respectable third player rather than being just a marginal third player, we'll have to wait for it to kind of get out of this existential crisis. And then there'll be enough opportunity for you to invest if things look up for them. But at this point, it's a bit of a very high risk, high reward kind of a thing, very high beta kind of a thing.
Okay. So for Vodafone Idea, Prakash, I don't know. Even if someone tries to be creative and think about any other final solutions coming in, not quite sure whether raising additional debt, and raising debt has been a problem in any case, or getting any other equity. Does anything come to mind? Of course, this will only unravel in the next couple of days. We don't have all the answers here this morning. So I'm just, it's a bit of an unfair question, but if you could guess what lies ahead.
Again, let's go back to history and see what happened when a similar situation of an impasse was reached. And, promoters were unwilling to put in more money, and, things looked very dodgy for it to kind of make it. But then eventually some money came through. Then you had that massive rights issue, the FPO and all of those. So, there will always be some way out, which seems difficult right now. And people look for the softer options, easier options, and that's being ruled out. And which is fair. I think in all fairness, converting AGR dues just for more equity where the government doesn't kind of solve the problem. They will need to restructure themselves in some way which is more definitive for a turnaround perspective. So let's wait. I'm sure there'll be something that comes up.
Okay, very quickly, Prakash, any view on Indus Towers? That's the one that normally moves when there is good news for Vodafone Idea. This makes things a little bit uncertain. And again, going back to the interview I had yesterday, the BofA analyst, Sachin Salgankar, was giving me a rationale that why he believes actually the Indian players, the tower players, should actually be rightfully trading at a discount in comparison to global peers. We often argue that there is very good, potential because of the valuation discount. But your view on Indus Towers with this sort of news coming in for Vodafone Idea?
No, I think Indus, as a key player in the telecom infra space, and especially with so much of focus on digitization and so much of fiberization, which is currently underway, will have enough business to grow, Nigel. I agree there is no reason for any kind of a panic on Indus just because of Vodafone's health getting to be circumspect. But there's enough business for them to kind of grow. And remember, we need more than 13 lakh towers. The number of towers in India is probably just 60% of that. So there's still a long way to go. And with the way the BSNL juggernaut is now rolling, you'll probably have enough expansion opportunities. Maybe not for Indus, but some of the other smaller players in that space. But I wouldn't really get worried about Indus and correlate it with the Vodafone situation.
Okay, all right, Prakash, thanks very much for joining in with the quick update on what you think of the development. The development being that it seems the government has also said that there's nothing fresh on its table with respect to offering any other relief to Vodafone Idea, and it's not looking to increase its stake beyond 49%. That's something it's said in the past as well. Let's quickly go back to our technical experts for some trading ideas then. So Darshan, 910, what's the call?
Well, it's IDFC First Bank. Consider buying it with a stop under 66.
Okay, and Mitesh, let's come to you.
I'll go with the banking name as well, Federal Bank, buy the stop at 203.5 for targets of 213.
Okay, all right. Thanks a lot for that, gentlemen. Well, let's do a quick recap then of some of the stocks that are buzzing around. Man Industries in the last 1 month, the stock is up 50%. Remember, it saw a sharp correction to around 250 rupees, and then in fact it's moved up. In fact, it's up 1.5%. Yesterday it was up close to under 7%. But you pull up a 1 month chart, you'll see the stock has already seen a big rally. However, there is favorable news that's come in overnight. What's that? They have raised funds by close to around 300 crores approximately. That's why the preferential issue of warrants as well as of equity shares. The promoter, they are putting some skin in the game. They have taken warrants, which will increase their stake in the company. And the warrants that they have, issued will be, on conversion, it will be close to around 40 crores. Remember, warrants can be converted in the next 18 months or so. The other part is the amount that they're doing to non-promoters. That is the bulk of it. So that is around 260 crores out of this 300 crores. And a notable name in there is Mr. Ashish Kacholia, who's taken around 9 lakh shares in the company. What are they going to use this money for? They have said they have capex plans in Jammu. They have capex plans in Saudi as well. So they're going to be using it for that. Working capital needs as well as balance sheet strengthening. And besides that, they're looking at some strategic initiatives. So Man Industries is a stock in focus. Favorable news. Keep in mind, the stock has seen a 50% run in the last 1 month.
All right. What a move indeed. So the 70-point, uptick is what we have as far as the pre-open is concerned. It's settled. And once again, as the pattern has been over the last 2 odd weeks, it's mid-caps that are doing better than the index. Plenty of names on the upside, including PB Fintech, of course, the recent listing, AG's walk back about 3% higher as well. Sudarshan Chemicals, some of these chemical stocks also looking quite okay at this point in time. Vodafone Idea, remember, it's a sub 7 rupees stock now, 2% lower. Now the ball is firmly back in the company's court, the promoter's court. What will the Birlas do next? That's the critical question. And of course, we'll keep getting you continued coverage on that. We're just about setting off. There goes the bell, and it's a quiet start, but with a positive bias. That's the good news for the bulls. So Eternal, Sun Pharma, Aisha Motors, these are the early gainers. ONGC seeing some traction as well. HCL Tech, Hindalco, these are some of the early winners. A whole 100 points up on the Nifty, so it's looking good. It's not like 1 or 2 stocks are doing a massive move. It's all small incremental positive gain that's adding up. Tata Motors, Tata Steel, Geo Finance, Reliance itself 0.7% higher. So these are the early movers. Eternal and Titan, 2 names from the discretionary consumption pack, looking very good. They're in leadership position on the Nifty. Not too many stocks on the downside, actually. Adani Enterprises about 0.5% lower. Adani Ports, 0.5% lower. Remember, there were the articles in the Wall Street Journal talking about some fresh challenges for the group in the US, something that the Adani Group has denied last evening itself. But those stocks have a tinge of red on them. Other than that, look at the banks, because the Bank Nifty is underperforming the Nifty right now. ICICI Bank, Axis Bank, slightly lower, down about 0.3%. But Nigel, it's not bad. 80 points up on the Nifty.
Well, that's right, Surbhi. Let's pull up a few stocks, though. Emphasis, they have clarified with regard to that news-based report on FedEx. They say that the company continues to be a service provider in FedEx ecosystem. The street is still a little bit nervous on this piece of news. And remember, it's PE-owned. So there's some speculation that maybe, in fact, that could be some kind of change of hands in the future. For the time being, the clarification is taken positively, and that's why that stock is up 1.5%. Transrail, they have bagged an order worth 530 crores across domestic and international geographies. That explains why that's one of the top gainers today. That's up close to around 5%. So big move out there. Niva Bupa, they have managed to get that block trade out of the way yesterday. We had a whole host of very good and solid buyers. So the street has taken that positively. It's up 2.5% or thereabouts. 2 large trades, one flashing for you on the screen. Zinca. Sources say that Quick Routes International will sell close to around 9% stake by the block deal. That was at a big discount of close to around, I think, 8%. But the deal has got done at around 423. Is that indicating good demand? Well, we'll get in Nimesh to tell us a little bit more about that. But it's happened at around 423 odd. So that's one stock. Aptus Value, that's the other one. Promoter is likely to sell closer on 9% stake in the company at a big discount as well. So Aptus is another one that's down closer around 8.5%. As we do that market check in the first 2 minutes itself, that big bounce has got sold into. The Nifty has now moved into the red. You'll have to say it's par for the course, because we have seen the markets in this broad band. Dips are getting bought into, bounces are getting sold into. What else is moving around? Yes Bank, that's down closer on 6.5% in today's trading session. The Anil Ambani Group stocks, that's Reliance Palm and Reliance Infra, they have had a splendid run in the last 4 to 5 trading sessions with massive delivery-based buying. Both of them have opened up with a cut of from 2 to around 3%. Interesting to see whether or not this dip gets bought into. So we'll keep an eye out on that one. And the new listing, Aegis Vopak, as Surbi said, it actually opened up down yesterday close to around 5%. But it seems, going by the analyst feedback, the street is looking at the FY27 numbers and they believe that the numbers will be very, very good. So on a trailing basis, the valuations were expensive, but part of the street is very, very bullish on the prospects going ahead. That's why that one is up and about. Surbi.
Okay, absolutely. So looking okay, but on the Nifty, must keep in mind that the early pop has been sold into. So there is some caution in the market. And from what was a 100-point up move, now we're looking at a 10-point cut. So a little quiet. And even the mid-cap index, for what it's worth, when it's at the index level, it's given up the initial opening highs. We'll keep tracking the markets, of course. Let's get to our next guest then. Manish Sonthalia, Chief Investment Officer at MK Investment Managers, is our market master on the show today. Great to be with you. Good to have you on the show as always, Manish. Very interesting times for the market. I mean, we keep hearing a narrative building that earnings will eventually improve, rate cuts are coming, local macros are looking very, very good. But the market's still nervous, kind of sitting at the edge around this zone of 24,500 to 25,000. What do you make of things now that Q4 earnings have wrapped up?
So, Surabhi, good morning. I think earnings has not disappointed at all. Both the large caps, mid caps, small caps, all have come in better than estimates. And broadly, around 3,000 odd companies reported something like 15% growth in PAT, which is much better than what was built into when we started the earnings season. So that's not too much of a problem. I think the problem is to do with, the nature of the market these days. I mean, when you have a whole lot of negative news, the market tends to bottom. When you have a whole lot of positive news, the market tends to top out. So in the near term, I think it's just to do with this tariff thing, 9th of July. Till that point in time, I would believe that it's difficult to take out 25,000, 25,500 on the upside, just because every bit of positive news has got priced in. And at the margin, you have seen the primary issuances, the QIPs, the press issues, they have started to pick up again massively. That was one of the main reasons why the markets actually tanked. You had a whole lot of primary issues get bunched up last year. So that's somewhat of a negative issue as far as the direction of the market is concerned. But everything else is on the positive side. I think market will bide its own time and maybe look forward to after the second half, towards the second half of this year, when you have all the monsoon and you have the rate cards, all of that got priced into.
All right. Hi, Manish. Good morning. Good to see you. Well, the number of large trades just continue, and Nimish will be joining in shortly to tell us. There are a couple of more that hit the screen. Yes Bank, the reason that it's down is because the P is likely to be a seller in today's large trade. And I think Ola Electric as well, there's a large seller out there. So these large trades just continue. Manish, what are you making of this fresh supply? The equity mutual fund industry, the domestic industry, was sitting on an ample amount of cash. Looks like a large proportion of it is getting deployed because in the month of May itself, promoters, that's the biggest risk, one would like to say. Share prices move up, markets get a little, buoyant, and they come in there and they cash out. Some would say rightfully so. Do you think it's a concern, or do you think taking some money off the table is okay? Your view?
So that does take out liquidity from the secondary market. If you have a whole lot of bunching up of issues, and we had a high test in the first 3 months of this calendar year when the markets were soft. And just that markets have started to pick up, you have a whole lot of issuances come through, and that do tend to take out liquidity from the secondary markets. And that's a big risk for the markets per se. And going by the number of issues that you still have for the whole of this financial year, I mean, it just remains a very big overhang. We just got to remember what happened in the last financial year. And if you don't have any solution to this, then obviously you'll have a problem in the secondary market.
While we wait for Nimesh to join us, because there are some, 4 or 5 blocks, he's been tracking each and every one of them, and the Yes and the Ola blocks have happened. While we wait for Nimesh to join in, on the lenders, Manish, we're at an interesting juncture. Yes is going through a metamorphosis, right, with the Japanese perhaps checking in. And then there is IndusInd Bank. The stock is halved. Everyone's waiting for a management transition. But every now and then you have these new shockers that keep coming in, that there was fraud, that this was not just a simple error, How are you looking at these two, lenders, mid-sized lenders, and IndusInd is, of course, a larger one, and the transition that they're going through? Manish?
Yeah, so of course, stock-specific actions will remain in the entire lending space, and both of these names which you alluded to are interesting names. Both of them look very good on a valuation front, and I think the Yes Bank issue seems to be lesser of a problem and can be a very big game changer now that you have a change in the management. IndusInd Bank, management issues need to be figured out, and then only valuations are absolutely fine. But we got to just figure out whether the entire thing has got cleaned up, and what is the new leadership going to do after they take over. So that's how I would look at it. But on an overall basis, not so too positive as far as the fourth quarter earnings season was concerned for the banks. High single-digit sort of numbers that came through. Valuations are perfectly fine, and now you will have a rate cut. So even there, you don't have too much of a margin expansion scope. You will be hurt on the margin side because everything will be a pass-through this time around.
All right. But you'll be positive on prospects of both these two banks, right? IndusInd and Yes Bank.
Yeah, they need to be kept on the radar. Get figured out into our universe, and we'll figure it out whether they are worthwhile buying. But both of them look interesting.
All right, look interesting. Not stocks for the faint-hearted, but as you're saying, you believe there's good reason to find it interesting. But Manish, I wanted to ask you about the other one that's not for the faint-hearted. Vodafone Idea, it seems time is running out for them. And any kind of hope, on a day-to-day basis, the news flow is not really supporting it. The analyst community, some part of it believes that we'll have a 3-player market. What is your take? What's the way out for them?
Oh, the latest news about AGR dues not getting a waiver from the government. How will they get the funds? That's the main issue. Because the Supreme Court has denied them that exemption. You now also have the government not relenting. So, in spite of the fact that we should be having a 3-player market, what is the financial viability of this company? That remains a big, big question mark. Unless and until you have somebody take over this sort of an entity with the liabilities that would come through. As a going concern, I don't know how they are going to survive. Just unable to figure out.
So you'll just stay away from that one?
Absolutely.
Okay, all right. Stay away from Vodafone Idea. Got that.
But just a quick word. Otherwise, Manish, Bharti, do you like the telecom space otherwise? Is that something that you have a favorable view on?
Yeah. So, Bharti is one of the names that we have in our portfolio. Even Reliance is there in our portfolio. So, I think both of them would be a play on the ARPU increase that's likely to happen over the coming years. Valuations are not very prohibitively expensive. Satellite telephony is around the corner, and all of these guys, both Bharti, Reliance, have a play in the satellite telephony as well. Okay. So I think it's a play on the ARPU game, and it looks interesting, both of them.
Okay, so otherwise you like the space and you like the leaders there, but cautious on obviously VI. Got that point. Manisha, stay on. We have more questions for you, but we were just discussing the blocks, right? The Yes block happened, the Ola block happened. So let's get our block man on with us in the morning, because he was alerting us about a lot of these stocks earlier on itself. And Nimesh, block season galore. Just recap the numbers for us, because so many hard to keep up with.
Well, Sir, so I was expecting 5 large blocks. 4 are done so far. 1 is still pending, but I'll start with Yes Bank, biggest F&O loser today. Remember, the stock rallied 8% yesterday, and today it's down 6%, 7% on the back of the large block. So 3% equity got changed hands at a discount, and hence the stock is under pressure. My sense is one of the large private equity investor was a seller in today's block deal. If you look at the scheduling pattern, there are two large private equity investors. Carlyle owns close to 6.8% and Advent owns nearly 10%. One of the large PE was a seller in today's block deal. My sense is Carlyle has sold half of its stake. In fact, the sense I picked up was maybe there could be a clean out from Carlyle, which is 6.8% stake. So need to see whether there are more blocks. But in the morning block, 3% equity has changed hands at a lower price. Hence, that stock is under pressure today. The second stock is Ola, which is also under pressure on the back of a large block. Even in Ola, close to a little over 3% equity has got changed hands at a discount. And in Ola, my sense is that Hyundai, either directly Hyundai or Kia, they were the sellers in today's block deal. Hyundai owns little over 2.5%, and I guess there is some holding via Kia as well. So, but as far as Ola is concerned, the feedback is that most likely Hyundai and the group entity has sold a stake in Ola Electric today. So these were the two large blocks. Apart from that, Aptus, we all knew that there was a book launch, so there was a large block expected. Westbridge has sold clearly 9.5% stake in Aptus. And also there was a big block in Zinca as well, where one of the strategic investors sold out. But two blocks which are important. One is Ola, where Hyundai is a likely seller. And in Yes Bank, my sense is private equity investor was a likely seller.
So that's 4 done. And Nimesh was saying there's one more expected today, right?
Well, let's wait for the chatter.
Okay. All right. Oh, right. Absolutely. So we'll, connect back with you towards the second half of the day. Thank you so much for that. So that's the lowdown on the 4 blocks that have already happened. Manish, it's incredible, right? I mean, you imagine the kind of liquidity that the market is able to provide to give exits, all kind of exits to PEs, to promoters, etc. Remarkable, really, how far we've come. On Ola, slightly broader question. I mean, the trajectory of this particular company in the market has just completely gone haywire, right? Just your thoughts on the EV space, if there's any other way you'll play it. And I'm broadening it even further. I think 5th of June is World Environment Day. So if you talk about a sustainable play, whether it's EV, renewables, solar, etc., give us 1 or 2 stocks which look good.
With bated breath, I'd be watching out for the launch of RE electric vehicle, which is Royal Enfield's electric vehicle. They're calling it the Flying Flea. And it can be a game changer or it could be a very bad move by the company because you won't have the thump, for which Eicher Motors is known for and has really is now clocking close to 1 million bytes every year. And that needs to be watched out very, very carefully. So, that is one name in the EV space that can be a game changer. I'm watching that with bated breath. We have this stock in our portfolio, very decently valued, very decent numbers, cash flows, etc. So, I mean, this is one name. Except for that, in the electric vehicle space, you have a whole lot of valuation issues, volume issues, even the solar and the wind. The valuations are just out of whack. So, would stay away from the narrative around EV to a very large extent, but just that one name that we have in our portfolio, and that can be a big move.
All right. In the past, I recall your bullishness on Royal Enfield. The Flying Flea is going to be launched, I believe, in the first quarter of next calendar year. I've started my recurring deposit. Maybe, in fact, if it's good enough, we'll take up on because every 6-7 years, normally I like to pick up a new motorbike. So I'll have that.
It's going to happen after increment season. So, makes it easy.
I just say that I'm keeping some money ready. Very quickly, Manish, before we let you go, I always make note of our guests who talk about stocks. And the last time around, I think you spoke about Star Health. And the stock did very, very well from there. I think it's up 20-25% from the time we last spoke. Continue to remain positive on this name. And if you want, you're feeling, generous enough, give us another name.
No, I think, not too many changes after the earnings season this far. But, continuing on Star, I think when you have all the negatives priced in and things are likely to get better at the margin, of course, there will be naysayers who will be saying, no, the loss ratio is not going to be between 65% or thereabouts. It's going to continue at 80% or 79%. Then you create an opportunity. And valuation that 20 or less than 20 prices to earning multiples and a huge runaway for growth in the health insurance space, I mean, looks like a sitter for me. So no new name just yet. And Star Health remains a good bet for me.
Okay, Manish, what a nice, lovely conversation. It's always great talking to you. And this time, I think we managed to get very, very specific on lots of themes, sectors as well. So thank you very much. And of course, the disclosures, the usual disclosures apply for all the stocks discussed. Thanks for joining in. You have a great day. For the time being, it's time to get back to some of the corporate conversations. We're going to be talking to Blue Star very soon. But before that, I just want to point out that the markets turned for the worst. We started positive, 100-point pop. That got sold into, and now it's an 80-point dip, almost a 90-point dip on the Nifty. So it's a downward trend line for now. Let's see if we get the buyers in at some point. But back to the corporate conversation. Then Blue Star is the company on the radar. We've seen a pretty steady quarter come through. Q4 was steady for Blue Star, at least at the top line front. Small issues on the margin, which we'll discuss. But the question is, what's the demand picture looking like? We have with us Mr. Rabi Tyagarajan, MD at Blue Star, joining in. Mr. Tyagarajan, good morning, sir. Always good to have you on. And I remember, when we spoke, I think this was in early April. That time, because of these unseasonal rains that were coming in, the April demand was not that great for air conditioners. I wonder how has May made up for it? Tell us, how has the year started off? What's your assessment so far?
Shubhi, good morning. It's a pleasure interacting with you. Yes, we had spoken in March. I had said that industry is looking forward to a 25% growth over last summer season. Industry indeed had prepared, and we had prepared for a 30% growth. April was bad with rains across many places, but most importantly, in March last week, as you may recollect, anticipating compressor shortage, the trade started stocking up more. So the inventory opening levels were very high in April. But the fact of the matter is there were rains across the country, and we managed to grow only by around 5% in April. May was bad. May, in fact, monsoon set in most part of the country. And therefore, this summer is a bad summer, like it was in 2023. This is going to be a tough period to navigate through and wait for the festival season. That's where we are.
All right. Hi, sir. Good morning. Nigel on this side. Good to see you, Ben. So it's a rough start to the year. If you could help us out with a couple of numbers. For last year, I think the RSC volumes clocked around 1.53 million, and you did very well because your market share as well moved to around 14% or thereabouts. For this year, what kind of a volume number should we be looking at given this soft start? The good news, though, is commercial refrigerators that had a rough FY25. That started off FY26 on a positive note with a good bump up out there, and that contributes a good amount to the UCP business. What is the number and what kind of growth should we look at in this vertical? Please go ahead, sir.
Good morning, Nigel. You're absolutely right. It was a significant year that Blue Star crossing the magic figure of 1.5 million and industry volume crossing 15 million. And whenever the summer season had failed, the rest of the season does well. And I anticipate at least 10 to 15% growth on a full year basis. In other words, FY26, one should anticipate between 10 to 15% growth. So that 1.5 million, it has got a potential to grow to 16 million. In our case, it will be 1.6 million. I think it should take place if I plot all the years in which summer season had been bad. In a manner of speaking, that we often talk about cricket, it is like rain, the Duckworth-Lewis method. So you work hard the rest of the period in order to make it up. So it has happened in the past. I don't see any particular reason why it should not take place. And we will continue to look at improving our market share. Our goal is to reach a market share of 15% by FY27, and we will be on that.
So just reiterating the numbers, you're saying 10 to 15% full year top line growth, right? You're expecting 3, 4 and 5, quarter 2, 3 and 4 to make up for it, right?
It picks up generally in end of Q2 and Q3 as the festival season begins. So I have plotted all the years in which summer season had been bad. So there is an indication that it will make up over the period. That's what one should anticipate.
Okay, all right. And just to reiterate, 1.53 is what it did last year. So a 10-15% growth will take you to around 1.7 million approximately on the RAC value.
1.65 is the one we will look at
1.65, got it.
number. And the commercial refrigeration you talked about, it was a bad year last year with many regulatory changes, etc. So therefore, it is doing well in whichever is the category, whether it is a cold store or whether it is a chest freezer, deep freezer, driven by the processed food consumption, pharmaceutical. These are the segments which are driving growth.
Sir, I just want to clarify this 10 to 15% growth guidance. This is only for the RAC business, or are you talking about overall top line? If you could just share the overall top line estimate as well that you have for the year.
I am talking about first the room air conditioner business.
Okay.
Summer season should have been 25 to 30% growth. It has not happened. But whenever summer season fails, it will be made up in the rest of the period. And I think 10 to 15% growth is possible. That is the anticipation. We will work towards that. Second is commercial refrigeration. It should grow between 25 to 30% because the base is very small and the demand continues to be good. And last year was bad. On that base, that growth should not be a problem. We are carrying forward order book of over 6,000 crores, as you may be aware, in the electromechanical project segment, and that should happen. Fortunately, Blue Star is not dependent on B2C alone. We have significant part of our revenue coming from B2B businesses. Commercial air conditioning business, which is driven by manufacturing, data center, shop, showroom, boutiques, that continues to grow. That should grow between 15 to 20%. So it is too early to predict overall Blue Star revenue growth, what it should be. I am of the view it will be definitely in double-digit growth. Yeah, one month or 2 months of rain will not create a major difference for us.
Okay, got that. So overall top line growth should definitely be in double digits. The AC business should grow 10 to 15%. Got that point. Sir, just a quick update on margins as well. Because in the fourth quarter, there was some pressure that came in on the blended EBITDA margin for the company. Though individually speaking, the RAC segment did well. There your margins were over 8% as well. So just give us some sense on both the EMP side, RAC, what's the margin profile and anticipation for the full year?
So I continue to maintain segment one, that is electromechanical projects and package air conditioners. It should be in the region of around 7.5%. In the unitary cooling products, which includes room air conditioners and commercial refrigeration, we have been maintaining full year basis. It should be 8 to 8.5%. In a summer impacted year, that will come under pressure. Something has to be made up in the last quarter. See, what happens is your marketing spends, you end up incurring something like IPL, etc. And it's not delivering because of the seasonal rains, unseasonal rains. So therefore, we will have pressure to deliver that 8 to 8.5. We are not changing that outlook. We will keep watching this. If it has to be corrected, I will let you know by H2 beginning. That's when we will have a clear picture. Okay. But it is possible to deliver 8 to 8.5.
That 8 to 8.5 on the AC business?
Unitary cooling products.
Unitary cooling products business. Got that.
Okay. All right. Sir, since it's been a rough start to the year, what about pricing? How does it move? Besides the shareholders, a lot of clientele as well will be watching you. They want to know whether Mr. Titagarh is going to go and push through another price hike. Possible or not?
No, April first week we had increased the prices and our policy remains the same. If there is an input cost increase, pass it on. If it is coming down, reduce the prices. See,
So now it's coming down then, sir. So, I see some input costs have cooled off a little bit. Will you cut prices a little bit because you took a price hike in January as well as April, right?
That's right, February as well as April. I think a review will take place beginning of the festival season, just before Onam. That will be in August. See, inventory is no longer an issue in the country for the simple reason local manufacturing is taking place, and we shouldn't have any problem there. Some minor adjustments will have to be done to enable the dealers to liquidate their stocks, which normally we all do. The price reduction or increase will depend on the outlook for input material costs and the exchange rates, which we will do in the month of August.
Okay. All right, sir. Thank you very much for giving us a complete perspective on how the business is playing out. So even though the start has been weak and these rains have kind of dampened the early summer demand, you're expecting the rest of the year to make up for it. Good to know that. Thank you very much for joining in. You have a great rest of the day. All right. That's the word coming in from Blue Star. We will take a very quick break on that note. Coming up on the other side, quick update with Mr. Umesh Chaudhary of Titagarh Rail Systems. Talk about the company's Q4 performance and the outlook. Welcome back. Let's just go back to the screens and see what the market's been up to. Still down about 70 odd points, but caps are fighting back as usual. There's some green on the mid-cap screen for sure. Let's pull up Swiggy. That's a stock in sharp focus. Right now on my screen, up about 2%. We've got Mangalam joining in with a quick update on this one. Mangalam.
Well, this morning there's a note that has come in from Morgan Stanley, and they've initiated coverage on Swiggy with an overweight trading and a target price of 405. This overweight, according to them, is premised on three things. One, improving execution in food delivery. Secondly, expanding quick commerce total addressable market and the aggressive investment that the company has made. And the third thing that they're saying is that the market is pricing in steep investments, but they're not yet giving any benefit on top line. And that's where they differ from the street, because they believe that it's a duopoly market, improved execution by Swiggy, and close margin gap versus Eternal, Zomato, that is for the food delivery business, is something that will do well for them. They've revised their quick commerce total addressable market estimates higher, close to $57 billion by 2030, and they assume that Swiggy will maintain its market share. What is it that they're expecting? They will say that the quick commerce business will be contribution margin break-even in the next 6 quarters, adjusted EBITDA break-even by second half FY29E. They've given a 25% discount to Swiggy's quick commerce business versus Blinkit, and about a 5% discount to Swiggy's food delivery business versus Zomato. And that's how they've come to the target price of 405. That explains why the stock's doing well.
Okay, all right, Mangalam, thanks a lot for that. Well, let's focus on another name then that came out with its set of numbers. That's Titagarh Rail. They saw a weakish performance, margins under pressure as well. In both the segments, I think there was some kind of weakness. The point is that they have some kind of issue with regard to the wheel sets. To understand more, we have Mr. Umesh Chaudhary, who is the Vice Chairman and Managing Director at Titagarh Rail, who joins us on the show. Hi, sir. Good morning. Thanks a lot for joining in. Well, it's been a little bit rough because of the point that you've been mentioning. The wheel set availability has been an issue for the past quarter, and I think it'll plague some part of this quarter's performance as well. So could you tell us where we are at with resolving this issue, and by when do you see things return back to normalcy, from quarter 2 onwards?
Yeah, so good morning. Thank you for having me with you. So there are two ways of looking at this wheel set issue resolution. One is the long-term permanent resolution, and one is the immediate resolution. The long-term permanent resolution is what we are expecting when our wheel plant, which is a joint venture with Ramakrishna Forging, comes into production next year. And that, wheel sets has been a perennial problem ever since we've been in this industry for the last 25, 27 years. Every couple of years, for 1 or 2 quarters, there is a problem that is faced from the wheel set supplies. And that's the reason why the government of India actually took up this wonderful initiative of making India truly self-reliant and setting up or encouraging setting up this wheel plant that we are doing so. So that is one. But on the short-term basis, there were some production challenges that Rail Wheel Factory was facing ever since, I think, if my memory serves me correct, since October or November. But now the production has, from this month, from June itself, from yesterday, it started streamlining. So from the month of June, we expect that the wheel set problem should be things of the past.
Okay, that's good news then, sir. Give us a few more details. How many coaches or, motors converters will you deliver in this fiscal year in comparison to last? If you could quantify it.
So absolutely. So we have two distinct lines of business. One is the freight rail system where we are doing the wagons. So last year we did the largest number of wagons that any Indian company has ever made in India. We produced about 9,500 wagons and delivered them. Of course, we could not achieve our target because of this wheel set problem, but nevertheless, it's a great milestone to have. And the second business that we have is the passenger rail system. There we have both metro, Vande Bharat, and propulsion. So coming to the propulsion that you were asking, the traction motor, this was the last year was the first year of our being in that business. And we did about 600 and odd traction motors, which is an average run rate of 50 traction motors a month. And this year we are targeting to ramp it up to about between 125 to 150 traction motors a month. And going forward, we'll ramp it up to about 200 traction motors a month. But that's only one part of the overall execution of the passenger rail system. The Pune Metro has gotten completed earlier. Now the Bangalore Metro is getting executed. And followed by that, the Gujarat Metro will start execution in end of Q2 or beginning of Q3. So, we've also started the production of the Vande Bharat coach last month. In April, we made the first cutting of the car body material for the Vande Bharat train. So overall, the passenger rail segment is going to be the one that is really going to see the big quantum jump in growth, both in FY26 and then followed by in FY27.
Absolutely. And those metro orders are continuing to roll in. Apparently, that's what the indications are. I think you're also L1 in the Mumbai Metro Line 6 tender. So I think all eyes on that one as well. So it's just some numbers, sir, because there are multiple businesses. I have, questions divided into several parts. Since we are talking metro rail, the passenger rail system, let's talk about that. From the metro business, what is the increase in the order book, the execution of that order book? What's the quantum of business you're expecting in metro rail? And if you could just, shine a spotlight on the Mumbai order as well.
So as far as the Mumbai order is concerned, yes, we understand we are L1 along with NCC in line 6, but we would not like to comment on that because it will be speculative. We would only comment on it when we physically have the order in our hand. So that's been our policy. But as far as the overall metro segment is concerned, or the passenger train segment overall is concerned, I think it's an extremely buoyant market. We are seeing new projects being announced. Jaipur announced their expansion of metro. We've seen Gurgaon. We've seen, every month we've been seeing some project or the other, because urban mobility is something which is the need of the hour, and it's the most urgent need of the hour. On a lighter note, I saw the comment of Minister Nitin Gadkari that he can solve all the road problems of the world, but not the traffic problem of cities like Bangalore. And the only solution is a metro system or an effective metro system. So coming to our capacity, we have just kind of done about maybe 2-3 cars a month on an average last year, which we are intending to ramp up substantially. We are wanting to ramp up to reach about 20 to 25 cars within Q4 of this month on a monthly run rate basis. And our ultimate targeted capacity, which is for both combined Metro and Vande Bharat, is about 800 to 850 cars a month. So that we are expecting to achieve by FY27 or FY28.
So with this expanded capacity, and a lot of that is going on stream by the end of this year itself, give us a sense, the metro business, what should be the revenue expansion we can expect?
As I said, it's going to be from 3 cars a month to 20-25 cars a month.
25 cars.
And then going to 27-28, FY27 and FY28, we are looking at getting it up to about 60-70 cars a month. So it's a huge leap that we are taking forward in this business segment.
No, absolutely. And now I'm going back to the wagon production, because you said a lot of these train set issues, the wheel set issues, that's getting sorted out. You had produced, I think, 2,455 wagons in the fourth quarter. Full year, you said you were close to, 9,500 wagons. So give us some sense of what will be the run rate, how much will you do this year as this wheel set problem gets sorted out?
So, there are two elements to that. One is the production capacity, which includes the supply chain of wheel sets, and the second is the order book. So, we are coming to the end of the order execution that we had received about 2.5 years ago. Of course, this will see us through to this financial year, to the end of this financial year, and we are expecting new orders to come in. And, I also believe that this is something that the government of India would definitely continue to procure, because this is the only way the logistic cost reduction is possible. So if we are able to get adequate orders by way of the new tenders that we are expecting this year, which we are extremely hopeful of getting, but at the end of the day, it's tenders that have to be floated, we should be able to stabilize at 1,000 wagons per month on a very easy basis. I would also like to mention that, I had mentioned earlier in your shows about the backward integration. So we have been able to expand our foundry production to about 25,000 tons, which is again a record production, which is much higher than what we had done in the past. And our new line of the foundry will come into stream in Q2 of this financial year. This would actually make us self-sufficient also for the foundry for 1,000 wagons a month. So that will give us the complete...
Yeah, that's 12,000 wagons in a year compared to about 9,500 that you've done this year. Got it. I mean, some rough estimates there.
All right. So what would that mean in terms of numbers then? Revenue growth, give and take everything. The wagons, the cars that you're referring to, coaches between that, various verticals. The street wants to know two numbers, and then I'll ask you the third one. First is, what kind of revenue growth can you deliver, and what kind of margin outlook for FY26 in comparison to FY25?
So you see, I'll answer your second question first. As far as margin is concerned, we've always maintained that on the freight side, we expect a margin of around 12%, 11-12%, give or take percent here or there on quarter-to-quarter basis. But a blended basis, 11 to 12% is a margin that is sustainable in this business, and we expect to maintain with that. As far as the top line of the freight is concerned, at 12,000 wagons, each wagon sells for between 35 to 40 lakhs. So that's the revenue targets that we are looking at. As far as passenger coaches is concerned, this is a business where we had really very little revenue going in the past. So as far as the ramp up is concerned, when we talk about one passenger coach, it sells for about 10 crores. And Vande Bharat, our share of the pie, because we are in consortium with BHEL, is about 4 crores. So it is a quantum jump that we are looking at on the passenger side. On the margin of passenger as well, I would divide it into two segments. One is when we have been able to integrate our entire propulsion, then we are looking at about a 14-15% EBITDA. But till we have been able to do that, which is going to take about 2 to 3 years' time, we should look at about a similar 10 to 12% EBITDA on the passenger side as well.
All right. So, ballpark, I'm just looking at 12,000 wagons at around 35 lakhs. That should give you around 4,200 crores approximately.
Yeah,
and on the other side, you said around 4 crores. And what is the quantity?
4 crore is our share of
Your share.
train, and 10 crore is our share of the metro coaches.
Okay, all right, 10 crore metro, got it. So ballpark, if I put the the numbers together, this year you ended up with close to around, I think, 4,000 crores, very, very approximately, 3,900 crores approximately.
That's right, approximately that much, yeah.
So we're looking at a 25% revenue growth?
I would not be able to give any forward-looking numbers right now. I mean, I've given you the execution, and of course, execution capacity I've given you. In the case of metros, we have the orders for the freight. Also, we have the order for this year. And then the execution will, of course, drive it. But of course, if I talk to if we talk about the capacity that we are creating, the capacity that we are creating in the PRS is almost 7,000-8,000 crores of revenue in a year.
Okay, all right. What about operating cash flow, sir? That was negative for the past year. Will you align things, and see a positive operating cash flow number?
Yeah, we will definitely be able to do that. This was primarily because, we had organized all our inventory, but the wheel set was a dampener, and that's the reason why the operating cash flow got blocked. Unless we had the wheel set, we could not convert the WIP or the inventory into cash. But that's a short-term phenomena. We are not worried about it at all.
All right, sir. Lots of details there. Thank you very much for patiently answering all of our questions. Gives us a good sense of how you're set up for this year. Thank you for joining in. Well, that's Titagarh Rail, and the stock has been doing, well, not too much today, but it's recovering from the lows, at least for the time being. Back to the markets, and we have Mitesh with us. Mitesh, volatile morning. Market's still down about 80 points. So it was up, then it's down, directionless at the moment. What's the advice?
Morning again. I think the index still remains very strong. The good thing is that now we are getting close to the lower end of the range, which is around 24,500 or so. So I think maybe around those levels, if you get another 70, 80 point kind of cut, you would look for some kind of reversal signals on the index and try to buy. On the stock side, I have a buy on SRF with a stop at about 29.30, targets of 30.50. I think that's a stock which looks like it's completed a correction and could move up. And the other stock is a sell on TCS with a stop at about levels of 34.65 and a target of around 33.70 can do that.
Okay. All right, Mitesh. Thank you very much for the calls there. So those are some trades to work with for the time being. Let's get back to the market. Q4 earnings season finally over, and it has been better than a lot of subdued expectations. So let's discuss this and more with Gautam Dugard of Motilal Oswal Financial Services. Gautam, always a pleasure to have you on the shows. I've got your note open in front of me. It says earnings review, fourth quarter FY25, beyond the benchmark, a surprise surge. So that's a pleasant headline to start with. But I must place on record here, because now that you've done the numbers, we ended FY25 with Nifty earnings growth of 1%, right? 1%. That's, I mean, we always knew it was a bad year, but that's still shocking. So 1% se to upar acha hi hoga. Definitely we're going to be much better this in FY26, right? But your thoughts on this earnings recovery that everyone's anticipating?
Yeah, good morning, Subi. Thanks for having me here. So look, FY25 ended on a flattish note for Nifty as well as the broader markets. A 1% EPS growth basically is a 4 to 5% profit growth. There's obviously a free float related factor adjustment depending on which company has driven the earnings. But suffice to say that FY25 was a flat year. And this year has come after 4 massive years of 24% earnings CAGR between FY20 to 24, right, for the broader markets, and close to 20% for Nifty. There were many factors, obviously, as we all know. We've seen that in the first 9 months. This quarter, the bigger news is not just Nifty, but beyond Nifty, which is why we wrote beyond benchmark. So, for example, if you look at the mid-cap coverage universe that we have of close to 90 stocks, the earnings growth is 19%, right? Large cap growth is 10%. My broader coverage universe of 300 stock, the earnings growth is 10%. And it's not led by one sector or two sectors. So there are 19 sectors which have delivered numbers which are either in line or better than expectations. Only 3 sectors have missed expectations. They are very small. Second, the breadth of the earnings has been fairly good. 74 to 75% of the coverage companies have delivered numbers which are either in line or better than expectations. This number usually is 64, 65%. So clearly, sequentially, we have seen better bottoms-up performance. Third, the upgrade to downgrade ratio has improved massively. The upgrade to downgrade was just 0.3x. This quarter it is 0.6x, right? While we have seen downgrades in FY26 for Nifty by close to 2.5%, but we are still expecting about 12 to 14% earnings growth next year. Now, obviously, the spread of the sectors will change, but this quarter has been fairly good. When we spoke at the time of preview, I would not have imagined that we will grow 10-11% this quarter. And that's why I highlighted that this is not led by one or two sectors. Multiple sectors have done well and beaten expectations.
Gautam, just rechecking that number, 19% was the earnings growth of your mid-cap coverage universe in Q4, right?
Yes. So 89.
Yeah, that's a good number. So I was just double checking on that. Got it.
Yeah. So 81 companies we cover in the mid-cap domain as per SEBI classification. For those 89 companies, we were expecting a growth of 9.6%. The actual delivery is 19%. And even if you exclude commodities, the growth is close to 15% for mid-caps. However, the bad news is that small caps struggled. So small caps, we cover about 122 small caps. For those 122 small caps, the earnings growth, earnings decline was 16%. entirely led by financials because there were a lot of MFI and some of the NBFC small cap companies which posted bad numbers. Excluding financials, also small cap numbers were flattish. So whichever way you slice or dice, small caps underperform, mid caps perform very well, and large caps perform in a very steady 10% kind of a growth fashion.
All right. Hi, Gautam. Good to hear your thoughts, and I was happy to read your note as well on Sunday night. Now, I want to ask you a couple of questions. You all are working with the 12% Nifty EPS growth for FY26. What's the downside risk to that? Because normally I see, even in the last year, a lot of brokerage firms, not just yours, started off with higher expectations, and gradually that graph came down, and we ended up with only 1%. And Surabhi sounding very optimistic. She's saying that this year, though, is going to be very good. What's the downside risk to that 12% earnings growth that we're working with?
So let me first speak for all the brokerages, because in FY25, it was the first year where we had to cut by such a big magnitude. And this was the first year where earnings got downgraded by double digits. FY21-22, we had upgraded estimates throughout the year. FY23 was very steady. We didn't cut, neither we upgraded. FY24, again, there was a 2 to 3% upgrade from where we began with. So, while it does give the impression that brokerages are always starting with a higher numbers and then they cut through the year, but the record is slightly different. 4 years, there was no number cut. FY25, therefore, was the first year in 5 years where numbers got cut by a big extent. As regards your question on what can go wrong and what can lead to downside in FY26, Nigel, see, we are living in a very volatile environment, especially globally. So commodities, obviously, while they do not have significant weightages in the indices, but their weightage in profit pool is massive. So, for example, if you look at Nifty 50 profits, in Nifty 50, commodities are roughly 20-25%, metals and oil and gas. And that's a number which keeps on changing every quarter depending on the underlying commodity prices. Plus, it also gets impacted by a lot of global factors. So that's a number where we usually don't have a very strong handle. We take it as it comes and mark to market it. Aside of that, I think 10 to 12% earnings growth doesn't look difficult. While the sectoral mix may change as we move forward, we might expect some sector to do well and something not to do well. It can interchange during the year. But 10 to 12% growth doesn't look that difficult to me at this stage if you're able to print a nominal GDP close to 9 to 10%. Right? Plus, you have income tax cuts, you have rate cuts which are happening. CapEx peaked up to March number was massive, 2.4 trillion. Come to think of it, that CapEx number of 2.4 trillion in March was our annual number in FY15. And whatever you've done in a quarter in 4Q FY25, the CapEx number was a full year number in FY20. So we've come a long way on CapEx. Obviously, this thing happens slowly. We tend to forget and appreciate the impact that it creates over a period of time. But I think CapEx should look slightly better as we move forward in FY26. So 10% is what you should move with or work with.
10 to 12%.
Yeah.
10 to 12% full year earnings growth FY26 for the Nifty.
Yeah. And then, of course, you have a hard work to do, which is to identify bottom-up ideas.
I was going to ask you to do that hard work. I mean, now tell us, which are the horses to bet on? Kaun se ghode jaldi bhagne wale hain, as they say, in this earnings race?
Yeah. So, Surabhi, look, we've had a very positive view on a few of the sectors, which fortunately has turned up quite well. For example, the financials, where we timely made the switch from underweight to overweight back in October. That has worked exceedingly well. If you look at the returns this year, calendar year 25 YTD, first 5 months, the banking index is up close to 10 to 11%, and IT index is down 14%, which is where we had cut weight in January. Now, it's our thesis since last many years, and we had put out 2 big notes on this a couple of years back, that in any given year, banks and IT do not outperform together. The only exception was CY17. Otherwise, job is slightly easier if you are able to pick between the two. And this year, we made that choice of picking banks over IT. So far, it is turning out well. There is a 25% outperformance by banks over IT. And not that we do not like IT. IT also is reasonably priced now, especially the large caps. But our overwhelming preference is for financials. And within financials, it is non-banks and non-lending NBFCs. So capital markets, there is preponderance of capital market plays in our model portfolio. So we like BSE, we like Angel, which is our 40% in the last 2 months. We like HDFC, AMC, Nuvama. In NBFCs, we prefer Shriram. And of course, in banks, we have Kotak Bank, ICICI, and HDFC. So banking is a big pack for us right now. Second, we like consumer discretionary, which has been the overweight stance for the last 3-4 years now. And it seems that consumer discretionary results this quarter were far better than expectation across multiple subcategories: jewelry, apparel, even footwear to an extent, and then QSR. And then we like industrials, we like telecom, we like pharmaceuticals. And incrementally, we are finding auto slightly better position. Now, we've been underweight on auto for a year, but given the current, risk reward, I think auto is looking attractive again. The expectations are very modest in auto, and valuations have corrected a fair bit there. So that is now looking like a stance that we might have to rethink.
Okay, interesting. Yeah, are we at some sort of an inflection point for the auto sector? Interesting thought to wind up the discussion on, and we'll probably, dwell on that in the coming chats as well. Thank you very much, Gautam. Always a pleasure speaking with you. Thanks for joining us.
Thank you.
Thank you. We'll take a break on that note, come back on the other side, and of course, as always, get you a roundup of all the commodity market action with Manisha. Welcome back. So let's find out what's hot in the world of commodities. We have Manisha joining in with the latest. Manisha, good morning. Now tell us, what do you have your eye on?
Well, overnight, almost all commodities have done quite well, whether it was energy, base metals and precious metals. So I'm looking at precious metals right now because we've seen 2.5% of gain in gold prices overnight. That one is trading at a 1-month highs. And the silver price has gained up by 5%. We're trading at a 7-month highs as far as the silver prices go. So when you look at the report card that stands as right now, on a month-on-month basis, gold is up by 2%, but silver clearly outperforming in the very near term there. When you look at the YTD chart, then the gold prices have gained up by 28%, while silver has gained up by 18% there. So silver still has to do that catch-up in sense of longer-term period averages there. But as you can see, it has been a strong report card that you can see for gold and silver both. Well, various factors which seem to be supporting. One is the dollar index, which is now trading at near 3-year lows, and that has been supportive. The markets also are looking at the Russia-Ukraine conflict escalating yet again. It has been going on for 3 years, but these spikes, even as there's conversation of ceasefire, leads to more premium buying in case of gold and silver. Also slightly risk off because we've seen some of the regional equity markets not do so well. That money seems to be flowing into gold as well. And there are renewed trade uncertainty happening yet again between US and China. The legal battle over legality of the Trump's tariffs is yet another thing that the street is watching quite closely at this point in time. And then you have reaction to the weaker than expected economic numbers from Eurozone, from China and from US as well. It also is about US doubling tariffs on aluminum and steel to 50%. So the last couple of days actually have been looking at stronger buying for the gold and silver prices there. And the US budget deficit of 1.9 trillion for 2025 and 36 trillion plus above for overall is something that will lead to gold buying going forward. The markets also will watch out for Powell testimony and various other Fed officials which are slated to speak in this week. We also have the US non-farm payroll data, the ECB monetary policies. These will give you further directions in. But at this point in time, we are trading very close to $3,400 an ounce for gold and almost $35 an ounce when it comes to silver as well.
Okay, all right. So green gains coming in over there. Thanks for that, Manisha. We do have to take another quick break. Coming up on the other side, our special segment, it's the economy. Today, Lata will be in conversation with Claudio Eriogin and Rahul Bajoria on the US and Indian debt markets.